Number 11, the entity can change its accounting policy if and only if such change is required by another IFRS. False.
Because
Because if the information can be like more relevant and like faithfully represented, okay, you can do that.
okay, we call that your voluntary change. When it is required by a standard, we're going to call it as a mandatory change. But PAS 8 also allows entities to change its accounting policies voluntarily. And the reason would be if such change would lead into better quality in our financial information. So that is what makes number 11 false.
A change in the measurement basis is applied as a change in an accounting policy and is not a change in accounting estimate. The answer is true because
Okay?
as provided by IAS 8 in the changes of accounting estimate, a change in measurement basis is a change in the values reported in the financial statements. So in other words, it is change in how the financial statements are presented and prepared. Thus, it is a change in accounting policy.
Okay, and this falls squarely in the definition of our change in accounting policy. So number 13 is true. Let's have number 15.
The corrections of an error shall be applied prospectively from the period it was discovered and future periods affected. False, sir, because it is stated here that it should be applied in the period it was discovered, but it should be applied earliest period practicable.
Okay, because again, as what we've mentioned last time, if we're dealing with a correction of error, a prior period error, the treatment is retrospective restatement. You change everything to the point that the financial statements would reflect as if the error never occurred at all. Change everything, change all the traces, change all the effects and impact of the error to the point that the financial statements would show that as if the error never happened at all. Okay, but very easy class. From the presence of the word prospective here, we should know that that is something to watch out for because again, if we're dealing with prior period errors, then it should be retrospective restatement.
Number one, this refers to applying a new accounting policy to transactions, other events, and conditions as if that policy had always been applied. Our answer is letter A, retrospective application, because the definition of retrospective application also falls into that statement.
Why is letter B wrong?
Retrospective application is different from retrospective restatement because it is applied. Retrospective restatement is applied in
Prior period errors. But what are we dealing with? Number one, man, we're dealing with a change in accounting policy. And again, if it's a
accounting
change
policy.
accounting policy, it's retrospective application.
So number 3, as provided by PAS 8, accounting policies, changes in accounting estimates, and correction of errors. In choosing a policy for a certain item or transaction, the entity should refer to the policy required by the standard that is applicable on the item or transaction. If there are no applicable standards, however, the management may resort to the following except our answer is letter D, follow any standard at the option of the financial statement preparer, provided such fact is disclosed in the notes to financial statements. Letter D, because letters A, B, and C shall serve as guide in accounting for the transaction, events, and conditions, which has no applicable IFRS.
So that's correct, class. Letter A, B, and C are actually provided in the standard on how to deal with areas in which no applicable standard is available. Now, what I want you to take note of, class, is that A, B, and C are in a hierarchy. If there's no applicable standard, you must first look for similar requirement in the standards for similar and related issues. Do not go immediately to the framework, class. Try to look first if there's a similar problem, there's a similar issue governed by another standard. Look somewhere else within the PFRS. If it's nowhere in all of the PFRS's class, that's the time you go to the framework. And if still the framework cannot help, class, that is when you are going to go to the other standard setting bodies. And this is what I want to remind you, class. it's very tempting, class, to give priority to letter C. Why is it tempting to give priority to letter C? Because letter C appeals to be very authoritative. What does letter C tell us? Consider the most recent pronouncements of other standard setting bodies. These are legitimate bodies or authorities. But I want you to remember that letter C would be the last in priority. Why is letter C last in priority? Because it does not have any application in our jurisdiction, class. The pronouncements by other standard setting bodies do not have any application in our place, in our jurisdiction. So that's why, even though letter C is very believable, class, it would be the least in priority because it does not have any applicability in us. I'm not sure if you already had political science subject, class, but you would have learned that the laws in other countries do not apply in our country, do not apply in the Philippines. The same for our standards. Standards that govern other areas, other places, should not apply in the Philippines. So do not go to other standard setting bodies first before exhausting the remedies available in our jurisdiction. Again, class, I've said so much, but the important thing to remember is you follow the hierarchy. First, follow alpha. If alpha is not helpful, you go to Bravo. If Bravo is not helpful, you go to Charlie. I hope that's clear to everyone.
Number 5. Which of the choices best describes the following statement? 1. In applying accounting policies, the standard requires that a policy should be consistently applied for similar transactions unless an IFRS specifically requires or permits categorization of items for which different policies may be appropriate. 2. An early adoption of an accounting standard is treated as a voluntary application and thus the entity does not have to comply with the transition provisions of the said standard. Our answer, sir, is letter A. First statement is true and the second statement is false because the first statement was clearly stated in the book, and the second statement is false because of the sentence, the entity does not have to comply with the transition provision of the standard. Changes applied when the standard provides transition provisions, sir.
Okay, you will have to comply with the transition provisions. That's correct. Very good.
Which of the following concerning change in accounting estimate is false? A. The effect of change in accounting estimate shall be recognized prospectively by including it in profit or loss in the period of change if the change affects that period only. B. The effect of change in accounting estimate shall be recognized prospectively by including it in profit or loss in a period of change and future periods if the change affects both. C. The effects of change in accounting estimate shall be recognized retrospectively by including it in profit or loss in the period of change and prior to it, if the change affects both prior periods and current period. D. All of the statements are true. Our answer here, sir, is letter C, because the change should be applied prospectively.
Okay, so letter C is definitely wrong. And Alpha and Bravo, class, are the two instances or the two types of prospective application. Now, this is what I want you to remember, class. Common misconception, class, is that when we are talking about prospective application, that the application is always now and the future. Okay? When we say prospective application, you apply the change now and future periods. But what letter A tells us, class, that there's another type of prospective application in which the change is only applied for one period only. And what period is that? Only in the current period. And when will that happen? It will only happen if the change does not have any effect on future periods. Again, class, my point is, common misconception is when we are talking about prospective application, it is always applied now and the future. But again, there's another type of prospective application in which the change is only applied now. It is not applied in future periods. And it makes sense, class, because it's possible for changes to affect only the current period. If it does not affect future periods, class, no need to apply the change in those future periods. Meanwhile, letter B, class, is our usual understanding of prospective application. You apply the change in the period of change and future periods. But when do we do this? Only if the change affects both the current period and the subsequent periods. So basically, class, prospective application, only apply it in the affected periods but never go back. Never go back. Is it possible for prospective application that is only applied in the current period? Yes, if only the current period is affected. Again, common understanding of prospective application is letter B, but my point is there's another type of prospective application and it is the one in letter A, in which the change is only applied for one period. It is only applied in the current period. Why is it only applied in the current period? Because it does not have any effects on subsequent periods. But again, what's common between the two is that you do not apply it retrospectively. You do not apply it to the past periods. Do not touch anything from the past, class. Only apply it now and or in the future. Okay? Let's have number 1 for 5-3, group 3.
The following are examples of changes in accounting estimate, except our answer, sir, is letter D because A, B, and C are accounting estimates, but letter D is an accounting policy.
Okay, so this is a very common kind of question, class. You would be asked to identify whether it's a change in estimate or a change in policy. Okay, you just go back to the definition for a change in policy, class, and change in estimate. But it also helps if you just remember the examples given for changes in accounting estimates and changes in accounting policies. So the answer for number 1 is indeed delta.
Which of the following requires retrospective application? Our answer is letter D, issuance of new standard covering an existing set of transactions, because, as what's stated in the book, retrospective application involves a change due to an application of a standard. There were neither mistakes nor omission. The change is applied only to present a financial statement as if it originally has implemented the new policy.
Okay, so out of the 4 choices, class, only letter D requires retrospective application. But can you please tell us what is required in Alpha, Bravo, and Charlie?
A change of method for estimating bad debts from percentage of sales to aging of receivables. It requires accounting estimate.
You're correct. It's a change in accounting estimate. And what is required if it's a change in accounting estimate? What kind of treatment?
Prospectively.
Okay, prospective application. So letter A requires prospective application. Class, many will get letter A wrong, class. Because of the word method, class, they would think as long as it's a method, automatic change in accounting policy. Again, the method is only involved in estimating bad debts. So that's why even though it's a change in method, but it's just a method in determining estimates. So this would still be a change in accounting estimate and therefore requires prospective application. How about letter B? Does it not require retrospective application?
No, it required retrospective restatement.
Okay, very good. Letter C.
A change of depreciation method from double declining method to sum of years digit method. Accounting estimate.
So therefore,
it requires prospective application.
Okay. Again, class, many students would get this wrong because they again encounter the word method. But again, the depreciation method helps you estimate the depreciation expense or the carrying amount of the asset. Still related to estimate. Still a change in accounting estimate. Please do not get this wrong.